Hello, John McConnin here with UpsideDownRealEstate.com and ForShortSales.com. Questions, it's January 2nd, 2013. Questions are coming up about taxes. In this case, I had a client who I thought was going to use the qualified real property business indebtedness exception, but she wanted to consider insolvency. And her property is going to close on January 7th or 8th, 2013. Well, the way to begin right now is I would get all my assets and all my liabilities together on the insolvency worksheet or my own spreadsheet at the time of closing, because the way the IRS looks at insolvency, they want to know, they want the snapshot of your asset picture versus liabilities immediately before the cancellation of debt. The cancellation of debt happens, in my opinion, at the closing in California because of 580E, which says if the banks agree to a short sale, they are releasing you from the remaining loan balance. So the cancellation of debt happens at the time of the closing. And so immediately before the time of the closing, you're going to include the fair market value of the property. You're going to include the amount of debt you have on that property. You are going to add up all your other assets and put them in the asset column with the fair market value of the property, and you're going to add up all your other debts and put them in the debt column for your liabilities. For instance, the question today was, well, what about my HOAs? I owe money there. Is that a debt? According to the IRS, they're pretty clear about it. They want all your liabilities in the liability column. So once you've done that, if you are insolvent, in other words, your liabilities exceed your assets, then you're going to come down here, you're going to take your 1099 income, maybe from one lender, maybe from two, because we just did this on the spreadsheet, included that liability. You can place that liability there if you're insolvent. Now, if you're not totally insolvent, if you have, let's say, $100,000 in 1099 income, but you're only $80,000 insolvent, I believe if you read the IRS website, and I want you to double check me with this, but you're going to put the smaller of those two numbers there. So although you might have $100,000 in 1099 income, you'll only be able to write $80,000 of it off, because this line, number 2 here, is total amount of discharge indebtedness excluded from gross income. You can't exclude the 1099 income past your level of insolvency here in this situation. So once again, to review, snapshot of your asset versus liability immediately before the closing, and then come over here to Form 92, work through it. You might want to check out the insolvency worksheet. And then, to make matters a little more complicated, and we've discussed this on other videos, if you follow your way through on all this stuff, in the end, you might have to transfer over some of the amount you excluded to, what do they call it? They call it the tax attributes. Let me just give you an idea. For some people, they're going to carry over $100,000. Now they're going to have to change their basis on the property, and they may have a capital gain in the property, but we still have a Capital Gains Exclusion Act. So if you're going to get your taxes done properly, we've discussed that before. We'll discuss that again in another video. But I just wanted to put you on alert that you need to follow through the rest of this and follow through what the IRS says to do. Thanks. You can, again, find these forums and more information at ForShortSales.com, or if you want to do a short sale with us, you can go to UpsideDownRealEstate.com. Thanks, John McConnin.